By the end of this video, you're gonna know which mortgage loan is for you. Today, we're gonna cover the somewhat confusing world of mortgage loans. It's a topic that might change your life forever. So grab your notepad and get ready to dive deep into the realm of home financing. We're gonna talk about 5 of the most common types of mortgages. The first one being conventional, second FHA, third VA, fourth ARM, more commonly known as adjustable rate mortgage, and 5, last but not least, 203k loans. By the end of this, you're gonna be a mortgage maestro. So let's get started, shall we? Let's dig a bit deeper into the ever reliable fixed rate mortgage, also known as the conventional loan. You've probably heard this term thrown around a lot. I don't know why I'm being so extra right now, but you've probably heard this thrown around a lot, but for good reason. So what's the deal with these anyways? When you opt in for a conventional loan, you're choosing predictability and you're choosing stability. It's where your interest rate remains the same for the entire life of the loan. There's no surprises, there's no sudden jumps in your monthly payments. It's your financial rock. But here's the thing, you might have heard a common myth about fixed rate mortgages. And that myth being that you need 20% down. But guess what? That is a straight up myth. While putting 20% down can help you avoid private mortgage insurance, PMI, and that might get you a better interest rate, it's not the only way to homeownership. The truth is, many lenders offer options for smaller down payments, and some offer as low as 3% down, 5%. It's all about finding what works best for your financial situation and your comfort level. So if you don't have 20% saved up just yet, don't let that deter you. There are other pathways to homeownership, and it's a definite journey worth taking. In a nutshell, fixed rate or conventional loans offer predictability and stability. They give you the confidence that your interest rate isn't going anywhere. If you're planning to settle down in your dream home for the long haul, this is the loan for you. It's like having that trusted friend that you can always rely on. And of course, if you're finding this information valuable, don't forget to subscribe and stay updated on all things real estate. All right, let's talk about FHA loans. They're backed by the Federal Housing Administration, and they are fantastic for first-time home buyers. You don't need a huge down payment, and your credit score can be on the friendlier side. So if you're just starting out on your home ownership journey, this is definitely one to consider. Now, let's take a closer look into FHA loans. The standout feature of FHA loans is undoubtedly the low down payment requirement, which is 3.5% of the home's purchase price. For example, for a $200,000 home, that's only $7,000 down. This accessibility is a lifeline for first-time home buyers and those who may not have substantial amount of savings. Number 2, credit score flexibility. FHA loans can be more forgiving when it comes to credit scores. While conventional loans might require a higher credit score, 680 or above, FHA loans are often accessible to individuals with credit scores on the lower side. This flexibility makes homeownership more achievable for a broader range of people. If you have for example, if you have a credit score of 580 or below, you'll likely need to make a substantial down payment, typically at least 10%. Keep in mind that while it's possible to qualify with a lower score, you may encounter higher interest rates and more stringent underwriting requirements. So if you have a credit score of 580 or above, you can qualify for an FHA loan with a down payment of 3.5%. This is an advantage for individuals who might not have substantial savings for a larger down payment. Lender discretion though. It's important to note that while FHA sets these minimum requirements, individual lenders may have their own guidelines that may require higher credit scores for approval. This means it's essential to shop around and find a lender that's comfortable with working with your specific credit profile. So I'll give you some credit improvement tips. If your credit is on the lower end of the spectrum, you can take steps to improve it over time. Paying bills on time, reducing outstanding debts, and correcting any kind of errors on your reports are proactive ways to boost your credit score and potentially qualify for a better loan term. All right, so we got low down payments, we got credit flexibility, and third is more lenient qualification requirements. FHA loans generally have more lenient qualification requirements, including a more forgiving debt-to-income ratio. This means that even if you have other debts, such as student loans or credit card debts, you may still qualify for an FHA loan. Well, what's the catch, you say, to FHA loans? While FHA loans open the door to homeownership with a low down payment, the catch is called private mortgage insurance, PMI. PMI is essentially an insurance policy that protects the lender in case the borrower defaults on the loan. Here's what you need to know about PMI. The cost of PMI can add to your monthly mortgage payments. It typically ranges from 0.3% to 1.5% on your original loan amount annually. The actual cost depends on your credit score, the size of your down payment, and the size of your loan. The good news is that PMI doesn't last forever. Once you've built up enough equity in your home, you can request to have PMI removed. Usually this happens when your loan balance is 78% of the original appraised value of the home. Alternatively, if you've been making your payments on time and you have reached 20% equity, you can request to have your PMI removed as well. Consider long-term cost. While FHA loans are an excellent option for getting into homeownership, it's essential to consider the long-term cost. PMI can add to your monthly expenses, and it's not insignificant. Compare this added cost to the benefits of getting into the housing market sooner rather than later. In conclusion, FHA loans indeed are a dream come true for many aspiring homeowners, offering accessibility and flexibility that can be a game changer. However, the trade-off is PMI, which adds an additional cost to your monthly payments. It's essential to weigh the benefits of low down payment against long-term cost of PMI when considering an FHA loan. Understanding these nuances can help you make an informed decision on your path to homeownership. Now, let's give a standing ovation to a special mortgage type, VA loans. These are like the superheroes of the mortgage world, designed to honor and support our veterans and active duty service members. If you've served your country, this is one mortgage option you definitely want to know about. VA loans come with some amazing benefits, and it's like a big thank you card from the government. The most outstanding perk, you can kiss that daunting down payment goodbye, because VA loans often require no down payment at all. Yes, you heard it right. Zero. Zip. Nada. That's a game changer for many. But that's not all. With VA loans, you can also wave goodbye to private mortgage insurance, PMI. That's another expense that's out the window. Your interest rates are competitive, and you have the flexibility to choose fixed or adjustable rates. Plus, closing costs are limited, and you can even ask the seller to cover some of those. That's a sweet deal. Another key thing to mention is the VA loan eligibility. Typically, these loans are available to active duty service members, veterans, certain members of the National Guard, and more. It's worth checking if you meet the criteria, because if you do, this could be your ticket to affordable homeownership. One more thing to note, there might be a one-time VA funding fee which helps keep the program going to support future service members. But this fee is often rolled into your loan, making it very manageable. So if you've served or are currently serving in the military, the VA loan is like the gift you've earned. It can open doors to your dreams of homeownership without a traditional financial hurdle. It's all about giving back to those who've dedicated their lives to our country, and we salute you for your services. Remember, homeownership is a significant milestone, and VA loans make that dream more accessible for our military heroes. It's a fantastic option to explore if you're eligible, and as always, if you're finding this information helpful, don't forget to subscribe. Number 4, adjustable rate mortgages, commonly known as ARM. These loans are different from the fixed rate mortgages we talked about earlier, because with ARMs, your interest rate isn't set in stone. It's like the financial equivalent of a roller coaster ride. Here's how they work. With an ARM, you usually start off with a fixed rate interest rate period for around 3, 5, 7, or 10 years. During this initial period, your interest rate is typically lower than what you would get with a fixed rate mortgage. This is where it gets intriguing for some folks, because those lower initial rates means lower monthly payments. Now the twist in the tale happens when the initial fixed rate period ends. Your interest rate becomes adjustable, meaning it can go up or it can go down based on the specific financial index like the US prime rate. This is where the unpredictability comes in. Your monthly payments can change, and it's not uncommon for them to go up. So why would anybody choose an ARM, you might ask? Well, if you're planning to stay in your home for a shorter period, let's say you're in the military and could be relocated, or you're investing in real estate and plan to sell the property within a few years, an ARM could be a smart choice. You get those lower initial rates and potentially save money while you're in the home. However, it's important to keep a close eye on interest rate market and be prepared for a potential rate hike when that fixed period ends. That's why ARMs are not for the faint of heart or the unprepared. It's a financial strategy that requires some risk tolerance and a good understanding of market trends. In a nutshell, adjustable rate mortgages can offer lower initial rates and monthly payments, making them an attractive option for certain situations. Just be sure you're aware of the risk and have a plan in place for when the rate adjustment kicks in. Number 5. Let's switch gears and talk about a unique player in the mortgage game, the 203K loan. Consider it the ultimate handyman's dream in the world of home financing. So what's the scoop on these loans anyways? Well, if you're eyeing a fixer-upper and have big dreams for renovations, then the 203K loan might just be that secret weapon you're looking for. It's specifically designed to help you purchase a home that needs some TLC and also provides you additional funds to make those necessary repairs and upgrades. It's like bundling your home purchase and renovation costs into one convenient package. With a 203K loan, you could finance the purchase of the property along with the cost of the renovation and repairs through a single mortgage. This means you won't have to dip into your savings or take out high interest loans for those much needed upgrades. It's a game changer for those who want to turn a diamond in a rough into their dream home. But of course, there's some paperwork and a few hoops to jump through. You'll need to work with a licensed contractor and get your renovation plans approved by the lender. It's a bit more involved than your typical mortgage process, but the end results can be well worth the extra effort. So if you're the type who loves a good project and can see the potential in a fixer-upper, the 203K loan could be your golden ticket. It's all about turning that diamond in the rough into the gem of the neighborhood without draining your savings. Just remember to do your due diligence and work with a professional who understands the ins and outs of this unique loan type. And there you have it, the lowdown on 203K loans. I'll have a follow-up video going more in depth on 203K loans, so make sure to subscribe and hit that notification button so you don't miss it when I upload. As we wrap up our discussion on mortgage loans, I want to stress the importance of careful consideration. Your choice of mortgage can have a profound impact on your financial future. Take the time to explore your options, weigh the pros and the cons, and make an informed decision that suits your unique circumstances. And if you appreciate the insights we've shared today, don't forget to hit that like button. And if you have any questions, leave them in the comments below, and I'll see you on the next one.